Ashish, while we've all talked a lot about the importance of long term when it comes to investing in equity, I think this is a phase which is probably reiterating that point. And perhaps, while some people had even talked about a 3-year kind of a time frame for equity, some talked of 3 to 5 years is a good time. Do you think that that needs to be re-looked at? Especially when you see this kind of a carnage, which we saw perhaps back in 2008, which you talked about earlier. How important is it to keep a long-term view? Because, people tend to say, yes, long-term. And then when you ask them how much is long-term, they say it's 1 year, 2 years. Probably in times like this, it's worth reiterating to people what really long-term in equity is, and why that's so important before you put even a rupee into equities.
Unfortunately, the thing about long term that everybody speaks is basically a little bit nuanced, right? Because when things are going great, we miss out on the nuances, and every once in a while, when the market gives a rude shock, that's when all the nuances tend to come out. Actually, so obviously, the thing is that when you look at long term. I always give my investors an example that in your business, if I told you that you have to increase your profit margins by 5%, without sacrificing volumes, and you have to gain market share by 5% without sacrificing your margins. So if you give anybody some such challenge with relation to their own business, generally the answer comes back is that it will take me 2 years, it will take me 1 year, it will take me 3 years, it will take me 5 years. So when we are conducting our own professional plans, or when we are conducting our own businesses, then we understand how much time it takes for a business to produce results. When we are investing in equities, obviously we are investing in somebody else's business, and it takes time for businesses to produce, not only produce results, but also to multiply their earnings power and deliver growth. So my sense is that equity investing from that perspective, as long as you're holding good companies or a portfolio of good companies through a mutual fund, my sense is that you should be willing to hold as long as you actually need the money. And times like these are important because people overestimate their need for liquidity and they underestimate their real time horizon for investment. It's almost childlike, just when you should not be accessing liquidity, people feel the urge to access liquidity. So I would say that, yes, for long term, we've always been saying it has to be 5 years plus. And I think that 2 more things I want to add. One is that when you say 5 years, look, as of February end, like we are now in early April, but as of February end, if you measured the 5-year return, it was a respectable number. And in March, the markets declined 30%, which is unprecedented. So obviously, if markets decline 30%, then the 5-year return should go down by 5.5% to 6% compounded. Actually, that should decline. Right, so the whole 5-year return could get erased. Now, my point is that if you measure it instead of Feb end, if you measure it in April end, now there is a sort of recovery in the market. If you measure it in May end, June end, July end, so numbers are transient in nature. Never insist on forming an appraisal on one particular date. So I would still say that 5-year plus is good enough. But what happens is that if my boss tells me that I will do your appraisal exactly on the day when it's your worst day of the year, or I will appraise you on the worst day of your career, then I think the rearview mirror will always look bad. That's why I said in the starting that where the rearview mirror looks disastrous is where the windscreen starts looking much better. So I would still say 5 years plus. And ideal thing is that you should not remove money unless and until you need it. The second ideal thing is never remove just because the values are down. The third is that, I would still say 5 years plus is good, but, there has to be some flexibility on when you are going to measure those numbers, because one month can make a hell lot of a difference. I think that is something which one should keep in mind. I think 2 years, 3 years, etc. is never on the discussion table at all, because that's not even one cycle typically. People generally believe that, in the space of 5 to 7 years is when an economic cycle kind of plays out, and companies go through cycles. So I think long term has to be as long as possible, really, but a bare minimum 5 years.
Always a pleasure talking to you, Ashish Somaya. Thank you very much for joining us here on the Money Mile, and wish you good luck, stay safe, and all the very best.
Thank you for having me. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.